For the last 6 trading sessions, cable has been grinding higher on the daily chart, painting a picture of unstoppable pound strength. The monthly trend is a strong buy. The weekly trend is a strong buy. The daily trend is a strong buy. And the 4-hour trend is a strong buy. So why do I have this knot in my stomach? Because right now, as price hovers at 1.3465, the 1-hour chart has flipped neutral, the momentum oscillators have flatlined, and the entire market is staring at a double header that can rip both ways. If you are long right here without a plan, you are walking into the most dangerous type of trap, the trend continuation mirage that snaps back into a liquidity grab before the real move. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow, complete with stops, targets, and the specific condition that voids each setup. This is your instant market verdict for the session ahead. The bias is a bullish lean trapped inside a tight range. We are not chasing the breakout blindly, and we are not fading the trend without confirmation. The market is in a pre-event compression coil, and that means the highest probability play is to position for the breakout after it confirms, or to buy a deep pullback into proven demand. The single number that flips everything is 1.3418. Write this number down. If we get an hourly close below 1.3418 today, the entire 4-hour structure resets, and the bullish bias will shift to neutral at best and outright short into the 1.3378 and 1.3344 supports. Right now, the herd is overwhelmingly long. Retail sentiment data shows nearly 70% of traders are holding long positions, and most of them have their stops clustered just under that 1.3415 area. The market loves to run those stops before the real move, and with the Fed and Bank of England decisions right around the corner, the conditions for a stop hunt are perfect. That is your edge, understanding where the pain trade lies. Let's go into the technical deep dive, and I'll talk you through what the chart is actually whispering, not what you want to see. Pull up your weekly canvas. The trend is undeniable. We have a sequence of higher highs and higher lows stretching back months. The 200-week moving average is way down near 1.2650, so price is trading at a premium. That tells you long-term momentum is intact, but it also means we are at elevated levels where pullbacks can be sharp. Now drop to the daily. The moving averages are your anchor. The 200-day moving average sits at 1.3386 and it is sloping higher at an aggressive angle. That is the ultimate bull market floor. The 50-day moving average is at 1.3473, just above current price, creating a near-term ceiling. The 20-day moving average is at 1.3466, almost exactly where we are trading. The 5-day and 10-day moving averages are both at 1.3459. What do you see? A cluster. The entire moving average structure from the 5-day to the 50-day is compressed within a 20-pip band. This is the calm before the storm. When moving averages coil like this and price sits right in the middle, an explosive expansion is statistically inevitable. Now zoom into the 4-hour chart. The support and resistance levels are crystal clear. Key support sits at 1.3418. Below that, the next major floor is 1.3378, and then the deeper pocket at 1.3344, which aligns almost perfectly with the 100-day moving average. On the upside, the immediate gatekeeper is 1.3490. That level has been tested twice in the last 48 hours and rejected both times. Above that, 1.3520 is the next structural resistance, and then the liquidity zone at 1.3562. That 1.3562 level is crucial. It represents the year-to-date high from 3 weeks ago, and a break above it would trigger a wave of stop-buy orders from breakout traders and fund managers who have been waiting for confirmation. Now let's talk momentum. Here's what most traders miss. Look at the 4-hour MACD. The signal line and the histogram are both at 0. 0. Not positive, not negative, completely flatlined. Meanwhile, the RSI is sitting at exactly 50.03, the midpoint. This is a textbook momentum vacuum. Price is not overbought, not oversold. Energy is conserved. When momentum resets to neutral inside a strong trending environment, the next impulse tends to be violent and directional. There is no hidden bearish divergence yet because we haven't made a higher high on the 4-hour chart. We've just been coiling below 1.3490. If price pokes above 1.3490 and the RSI fails to make a new high, that will be your negative divergence signal, and that would be the trapdoor for longs. But we aren't there yet. Right now, it's a spring coiling, and here's another layer. Cable is moving tick for tick with the UK's 2-year yield spread. That spread has been narrowing in sterling's favor over the past 2 weeks, which is exactly why the daily trend is so strong. But in the last 24 hours, the spread has stalled. It's coiling just like price. So the bond market is waiting for the same catalysts. Cross-asset linkage check. The dollar index is pinned at a key support level itself, and equity futures are churning without direction. This is a macro standoff, and cable is at the epicenter. Let's bring in the fundamental driver. The core news in the last 24 hours is Bank of England policymaker Megan Green stating that the case for rate hikes grows stronger. That's hawkish. That should be pound positive. And yet, cable couldn't break 1.3490. Why? Because the market has already priced in a significant amount of hawkishness from the BoE. The marginal impact of one more hawkish voice is limited when the entire committee is already tilted that way. The real game changer is the double header. The Federal Reserve decision and the Bank of England decision are both on the near-term calendar, and the options market is pricing in the widest expected range in months. The analyst consensus, the sentiment article you need to have in your head, says it perfectly. Pound sterling to US dollar needs the Fed BoE double header to break its tight range. This is not a secret. Institutions know this. So what happens? Smart money doesn't commit ahead of the event. They wait, and they let retail push price around in a tight band, accumulating positions in both directions to fade the breakout initially. My 1 to 2 week directional lean is cautiously bullish. The path of least resistance after the event risk clears is an upside resolution, targeting 1.3562 and then possibly 1.3650. But that outlook is immediately invalidated if we get a daily close below 1.3344. A close below that level would signal a failed breakout and a deep retracement into the 1.3200 handle. So the pivot is wide, but it's tradable. Right now, do you think cable breaks 1.35 this week? Comment yes or no right in the comments. I'm tracking the consensus live, and I want to see if this channel is aligned with smart money or stuck in the retail herd. Now let's get into the trade setups. Most people skip this section. That's exactly where the money is made. Keep watching, because these 3 strategies are built for exactly this type of coiled market structure. Strategy 1 I call the sniper, the conservative play. This is the breakout confirmation entry. You do not buy the first touch of 1.3490. You wait for the 4-hour candle to close above 1.3490. And then you enter on a successful retest. The exact trigger condition is a 1-hour close above 1.3500 after that 4-hour break, confirming the level has flipped to support. Your entry is 1.3505 on a limit order or a market entry once the 1-hour candle closes with conviction. The stop loss goes at 1.3440. The logic is simple. That's below the 4-hour demand zone, below the moving average cluster, and below the level where late breakout chasers will have their stops. It gives you a clean 65 pip stop. Target 1 is 1.3560, just ahead of the year-to-date high where profit-taking will sit. Target 2 is 1.3620, a measured move based on a range projection. The risk-reward on this trade is 1 to 2.6R, and it's the highest probability play if you have patience. What voids this setup? If after the breakout, the 4-hour candle closes back below 1.3475, the breakout has failed, and you exit immediately to the sniper, conservative, entry. 1.3505, 1H close above 1.3500, stop loss. 1.3440 take profit 1. 1.3560 take profit 2. 1.3620 risk, reward. 1:2.6R invalidation. Void if 4H candle closes below 1.3475. Strategy 2 is the active trader. the standard pullback play for those who want to engage with the trend without waiting for the breakout. The condition is a mean reversion into the key support at 1.3418. You wait for price to dip into the 1.3425 zone. That's the entry window. You need to see a bullish rejection wick on the 15-minute or 1-hour chart before entering, a clear sign that buyers are defending the level. Your entry is at 1.3425. The stop loss is placed at 1.3390. That's below the 1.3418 support, below the 200-day moving average, and gives the trade enough room to breathe without being taken out by a fake out. Target 1 is 1.3490, the range high. Target 2 is 1.3530, just beyond the first resistance, where momentum will carry into the next zone. Once target 1 is hit, move your stop to break even and let the rest run. This is a 1 to 3.4R setup. It takes advantage of the strong daily trend buying a dip. What voids it? If price slices through 1.3418 with no wick and the 15-minute candle closes below 1.3410, do not enter. Wait for lower support. Right now, type your cable range for tomorrow in the comments. Call the high and the low. Let's see who's aligned with the levels I just mapped to the active trader. Standard, entry, 1.3425, bullish rejection wick on 15M1H, stop loss, 1.3390 take profit 1, 1.3490 take profit 2, 1.3530 risk, reward, 1:3.4R invalidation. No entry if 15M candle closes below 1.3410. Strategy 3 is the aggressor, the high-risk fade. This is for traders who can lose small and manage risk aggressively, and it is counter-trend. You are betting that the 1.3490 resistance holds one more time before the double header, trapping breakout buyers and triggering a quick flush. The entry is a limit order at 1.3485, with a stop loss at 1.3525, just above the 1.3520 resistance and above the recent swing high. That's a 40 pip stop. Target 1 is 1.3420, right at the support zone. Target 2 is 1.3380, near the 200-day moving average. The risk reward is 1 to 1.6R, so it's not a high reward setup, but it is designed for a quick scalp on a rejection. The setup is voided completely if the 1-hour candle closes above 1.3490. If you see that close, do not short, accept the loss and flip to the sniper long. Only take this trade if you have a proven track record of cutting losing trades instantly. The aggressor, high risk, entry, 1.3485, limit order, stop loss, 1.3525 take profit 1, 1.3420 take profit 2, 1.3380 risk, reward, 1:1.6R invalidation, void if 1H candle closes above 1.3490. Risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No new positions through high-impact news events. Stops are non-negotiable, hard stops, not mental stops. This is how you survive to trade the next big move. Even the best setup can fail when a central bank surprises. Let's close with the one level you must watch for the next session and tomorrow's wildcard. The single most critical level is still 1.3490. If we get a daily close above that, the breakout is real and the target is 1.3562. If we get rejected and close back below 1.3440, the range holds and the pullback to 1.3418 becomes the high probability scenario. Tomorrow's wildcard is the Fed BoE doubleheader. The volatility window will be extreme. I'll be covering the full breakdown of the dollar index reaction and the euro to US dollar trap on the other side of this event, and that video is live now. Tap the end screen to watch it. Smash the like button if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one before the market opens.